As we stand at the threshold of the final trading weeks of the year, the performance of the broader market has been a mix of cooling optimism and specific pockets of intense strength. Today is Saturday, December 20th, 2025, and while the physical trading floors are quiet, the digital hum of analysis never stops. Looking at the final tape from yesterday, Friday, December 19th, Amphenol Corp, trading under the ticker APH on the New York Stock Exchange, closed at a price of $135.29 USD. This represents a substantial intraday move of plus 5.68 or a 4.38% gain on the day. The volume was particularly heavy, with over 17.5 million shares changing hands, which is more than double its typical average daily volume. For those watching the ticker closely on a Saturday, it is important to realize that the market is currently closed, and this $135.29 figure is the settled closing price from the most recent active session. Now, while most investors are looking at that 4.38% jump and thinking it is just a routine tech rally, there is a much deeper layer to this price action that has caught the attention of institutional desks. Usually, when a stock of this size jumps on high volume, you look for a single headline. But with Amphenol, the reality of this move is actually a delayed reaction to the massive consolidation we have seen in the electronics component sector over the last quarter. While the common belief is that the AI trade is strictly about the chips, the structural reality is that you cannot move a single byte of AI data without the physical connectors and high-speed cabling that Amphenol dominates. The market is finally waking up to the fact that the backbone of the entire data center expansion is built on parts that cost pennies or dollars, but carry the risk of billions in downtime if they fail. This creates a massive pricing power moat that most retail investors completely overlook. The general expectation for APH over the last 6 months was that the stock might struggle under the weight of its own success, especially after hitting record highs. Many analysts were calling for a breather, citing the massive 90% run-up in the trailing 12-month period. However, the reality we are seeing in the price action tells a different story. Instead of a correction, we are seeing a rotation. Large-scale institutional players are shifting capital out of high-beta software names and into picks and shovels plays like APH. This is evident in the fact that even as some mega-cap tech names fluctuated, Amphenol remained resilient, steadily climbing toward its 52-week high of $144.37. The tension here is between those who think the stock is overvalued at a 45 PE and those who realize that in a world of accelerating electrification, a 45 PE might actually be a discount for a company that hasn't missed an earnings beat in years. When you look at the recent stock movement, the daily swings have been remarkably tight until this recent breakout. We saw a period of institutional accumulation throughout late November and early December, where the stock hovered around the $130 mark. The surge to $135.29 isn't just a random spike, it is the result of the market processing the sheer scale of the Trexon acquisition and the upcoming closing of the CommScope CCS deal. These aren't just small additions, they are strategic land grabs in the industrial and IT datacom markets. When we look at the trading volumes, the spike to 17 million shares suggests that a major fund, or perhaps a group of funds, finished building a position, likely ahead of the new fiscal year. If you are currently managing your own portfolio, perhaps through a platform like Robinhood or Interactive Brokers, you might notice that APH doesn't get the same meme attention as something like Tesla stock or Nvidia stock, yet its performance has frequently outpaced the broader indices with much lower volatility. For those using tools like Schwab Intelligent Portfolios or various investing sites to find stability, APH has historically been that quiet winner. It is the kind of individual brokerage holding that builds wealth through consistent execution rather than flashy product launches. If you look at your own holdings on the Fidelity mobile app or through your SoFi active investing account, compare the drawdowns of APH to your other tech holdings. You will likely see a pattern of much faster recoveries, which is a hallmark of institutional trust. The recent earnings reaction was another moment where expectations were completely shattered. In the third quarter of 2025, the company reported a massive beat, with revenue hitting $6.19 billion, a 53% increase year over year. Think about that for a second. For a company of this scale to grow its top line by over 50% is almost unheard of outside of the semiconductor space. The adjusted EPS of 0.93 crushed the analyst consensus of 0.79. This is where the curiosity loop really begins. How can a connector company grow like a software startup? The answer lies in the harsh environment solutions and the IT datacom segments. Sales in the harsh environment segment jumped 27%, while IT datacom essentially doubled. This isn't just a cycle, it is a structural shift in how much electronic content is being packed into every industrial machine, aircraft, and server rack. Despite this stellar performance, there is always the contrarian view. Critics point to the recent insider selling, where the CFO and other executives sold shares worth roughly $148 million over the last 3 months. In the world of online investing, this is often seen as a red flag. However, if we look at the context, these sales often happen at predetermined intervals or for tax purposes after a stock has doubled in value. It is more important to look at the institutional ownership, which sits at a staggering 97%. When the smart money owns nearly the entire float, they are not looking at the daily noise. They are looking at the 27.5% operating margins that Amphenol managed to squeeze out this quarter, a 560 basis point improvement from the previous year. Let's take a step back and look at what this company actually does to understand why these numbers are possible. Amphenol is not just a parts company, it is a provider of high-technology interconnect, sensor, and antenna solutions. Founded way back in 1932, it has survived and thrived through every major economic cycle by being ruthlessly decentralized. They operate through hundreds of individual profit centers, each with its own general manager who is held directly accountable. This culture prevents the kind of corporate bloat that kills innovation in large companies. Whether it's a molded radio socket from the 1930s or the latest TS1 series high-performance industrial power connectors for EVs today, the business model remains the same. Find a complex electrical problem and build a rugged solution for it. Their portfolio is incredibly diversified across markets like automotive, broadband, commercial aerospace, defense, and mobile networks. This diversification is their ultimate defense. If the mobile device market softens, the surge in defense spending or aerospace orders picks up the slack. For example, while consumer electronics have seen some headwinds recently, Amphenol's aerospace and defense segments have been buoyed by the global push for fleet modernization and increased military readiness. This is the kind of self-investing insight that long-term holders value. While others are searching for investment help on message boards, the data shows that APH is essentially a bet on the continued electrification of the global economy. Now, as we look toward the future outlook, we have to consider the catalysts for 2026. The company has already provided optimistic guidance for the fourth quarter, expecting sales between $6 and $6.1 billion. But the real story for next year is the integration of the CommScope CCS business, which is expected to close by the end of the first quarter. This will further solidify their dominance in fiber optics and communications networks. Furthermore, the board just approved a 52% increase in the quarterly dividend to 25 cents per share. This is a massive signal of confidence. Usually, companies increase dividends by 5 or 10%. A 52% hike is management shouting from the rooftops that their cash flow generation is better than ever. Before we move into the final analysis, I want to hear from you. Comment below how many shares of Amphenol stock you currently hold, or if you're looking to add it to your watch list for 2026. Does the current 45 PE ratio scare you off, or do you think the growth justifies the premium? I am curious to see how many of you are playing the picks and shovels side of the tech trade versus just holding the big names like Nvidia. Looking at the risks, we have to talk about valuation and macroeconomic pressures. The stock is technically in overvalued territory according to most traditional DCF models, which suggest a fair value closer to $104 USD. If we see a broader market pullback or a sudden spike in interest rates that hurts high multiple stocks, APH could see a sharp correction back to its 200-day moving average, which currently sits at $117 USD. There is also the threat of intensifying competition from TE Connectivity and Belden. While Amphenol has the best margins in the business, TE Connectivity is a formidable rival with its own strong footprint in AI and automotive. If Amphenol stumbles on its integration of these new billion-dollar acquisitions,